The Headless Horseman here. It's July the 10th, 2024. First of all, thanks to the sponsors. Let's look at the markets. Gold at a good price. Silver, actually it's still above 31 bucks. I haven't really watched the metals that much for the. I found myself looking less and less at the metals. I don't know exactly where that comes from. Maybe because they've been so volatile and basically been going nowhere, so you don't feel like there's a point to look, if you know what I mean. Because like one day it's up, the next day it's down, one day it's up, next day it's down, so you kind of get into that. You get somewhat bored of it, I guess. But that's a good thing, obviously. It's like I thought about this. I mean, when you or if you read any of my cases, for example, I mean, I don't think I ever really refer to the price for gold or silver. Or I should say, none of the cases have like well, if gold goes to this level, or if silver goes to that level, then this is why it's like I love this story, or I really like this story. Maybe people should check this story out because yada yada yada. And if gold goes to, like it would be a part of the bullish case. That, I mean, yes, by default I guess that's true. Because I am bullish on gold and silver and copper for the next 5 to 10 years. So I think we're in a commodity bull market. So that's the underlying theme. I mean, it's not like I think prices of gold or silver are going to be trending down for the next 5 to 10 years. It's like, then I would probably, maybe even stick to another sector, for example. But I think that's the tailwind we have. But at the same time, it makes no sense really, unless again it's an optionality play kind of case, or silver or gold have been down, whatever. It's like 50% down, and then that everything is pretty much crashed, and it's going to turn around. In this case, we have the luxury, let's say, especially for gold. The gold is at this very, very nice price. And you can still buy gold projects, non-producing gold projects, like gold was at 1700, 1600. That's a real luxury. That's why I still think that gold juniors, for the last 2 years especially, maybe actually 3-4 years, have the by far best risk reward, just inherent risk reward, because the gold price has done so well. So it's not reflected at all. If you look at the majors, for example, where they have their kind of what metal prices they base the resources on, or reserves I should say, you typically see, I think I saw Agnico Eagle, for example, excuse me, Agnico Eagle recently, in one of their presentations. They have like a reserve price. It's basically what they think at at what metal price can we mine this amount of gold profitably, let's say. So if they have it based on a $1,400 gold price, and the reserves are 3 million ounces, they think that, okay, at $1,400 gold, we think we have 3 million ounces that's profitable. If they had a reserve price of, let's say, $2,000 gold, then maybe the deposit would be for $5 million, because you would include a bunch of lower grade stuff that wouldn't work at $1,400 gold but would work at $2,000 gold. So I see a lot of majors, they have like gold, I think, Agnico, I think, had around $1,400. There were some that were at actually $1,300, $1,350. But like, they have a $1,000 per ounce margin in the reserves. That's pretty crazy, isn't it? I mean, they're way. I mean, it's just way. The spot price is way above the assumed price in the reserves. Silver, I think, I've seen like maybe $22. Silver is obviously quite a bit higher than that as well. So actually, silver price looks to be pretty high. I mean, much over what they assumed is like what they would need. But copper, I think I see a lot of like $3.6 per pound. I mean, in the case of gold, that's like, I don't know, 60-70% margin of safety, or I guess it would be the opposite, but it's like $1,000 higher than the reserve grade. In silver, let's say you are at 20 reserve grade, that's, the price is 50% higher. But in copper, I don't think I've seen that. I mean, 50% higher, I don't typically see. So copper is, I would say, spot price of copper is closest to the reserve grade for the or the reserve gold price or copper price they use, the major. So in that sense, you can kind of just argue perhaps that's like, well, it looks like the gold business is the best business because the majors are using $1,400 gold for their production to see what works, and it's at almost 2,400. Silver also pretty high. Some almost 50% higher. Copper not so much. Copper is obviously what a lot of people are very bullish on in the future. But my point is that I gotta admit I haven't checked too many copper producers, but I don't think they're making money hand over fist, most copper producers, unless it's like Cadia, for example. I mean, the Cadia mine, which is just, I don't know what their all-in sustaining costs are, but then again, I think they might be using the copper credits to offset. So it's just that they appears to have a very, very low cost of gold production. But I hope you understand what I mean. It's like many of the gold mines, at least the semi-decent one to better ones, they work at much lower gold prices. Kittilä in Finland for Agnico Eagle has a total cash cost of, I think it's around $950 or $1,000 per ounce. So I mean, everything above $1,000 in the gold price is margin. I mean, it's like the gold price could theoretically go down $1,400 before Kittilä starts to become economic. That is a huge margin of safety. Again, I don't think you can say the same for copper. It's like, copper drops 30-40% in price from here, and they just break even. No, I think most copper mines would probably lose a lot of money. I don't think maybe many copper mines are making good money today. Silver depends. It feels like silver is much trickier, whereas like you have the, let's say, really high grade good mines like Silvercrest. I don't know what their all-in sustaining are, but I think they're pretty low. So as always, it's like one asset is better than the other in terms of margin of safety. But at like $2,380 gold, almost every project makes a lot of sense on paper. No matter how shitty it really is, or comparably speaking. It's like it's a tier 4 project. But on paper, at these gold prices, make a shit ton of money. It's like Rupert, for example, their Icary. I think their base case is $1,600 gold or $1,800 gold. I mean, when you see juniors needing, let's say, they use $2,200 gold as their almost base case, then you're like, okay, then it doesn't sound like such a good deposit. I mean, Rupert, obviously, Icary's case, I mean, they want to be bought out. I mean, they're not catering to the retail investor, if you know what I mean. And one of their bragging points is that, hey, Icary looks this good even at $1,600 gold. That's obviously very attractive. I think actually Skina is doing something similar. I think their base case last I looked was like, $1,700 gold, maybe 18, maybe 1,600. So it's kind of a worrying sign if you see a junior that's like, okay, how do we get people to want to buy this product? Typically it might be, retail, cater to retail, then they use, a very high gold price as their base case. And, if you go down to 18 or $1,600 gold in the PEA, then it's like, oh, nobody would really care about this. So, which kind of brings me to the next thing. I did a poll on Twitter, I think 8th of July, so 2 days ago. Which juniors have the worst sentiment? 503 votes. Lithium got highest. Next silver. Then gold. Then nickel. I gotta admit, I don't follow lithium that closely. But I was like, yes, I've seen some lithium juniors get absolutely obliterated. So I guess that's kind of fair in a sense. The problem is, like, how do you think about this? It's like, yes, if we look from top to bottom, because lithium juniors were so hot, and even if you didn't have anything really except a land position, you could get up to 100 million plus. So the fall is very high because the lithium hype was so enormous. So it started off from a very, very high elevation before it fell. But at the same time, when you look at some, let's say, lithium juniors, maybe they only have a land package still. And yes, they're down to a few million in market cap, but it's like, and then you look at maybe some gold juniors, for example, that have kind of a project already. $15 million of sunk cost. They have, 1 million ounces of resources. And they're just valued at, twice what a grassroots lithium explorer is priced at. Then the question is, like yes, the lithium junior might have fallen a lot more, and it's at an absolute lower market cap, but which is actually cheapest, if you know what I mean. So I'm not 100% sure. I think this also is a kind of a signal. The question is which juniors have the worst sentiment. I actually think this is actually a more this vote or this poll result is more showing what, let's say, retail is mostly focused on, if that makes sense. Silver, we know that's notorious for being the favorite speculative sector of retail, because everyone has heard, it's like that's what got me into silver. It's like you heard people talk about $100 silver, $500 silver, and we've seen what happened in 2011. We know that silver can just go exponential and all of that. So it's always been attracting the most, let's say, risk-on type investor, want to get rich quick, and that's, every one of us kind of inherently want that. And lithium was like that. Everything just went up. So a lot of people got rich quick. So I think it's actually, because I wouldn't agree, for example, I don't at all think nickel is the most popular juniors. Or it's like that the nickel juniors have better sentiment than the silver, gold, and lithium juniors. I don't buy that at all. Just looking at the more, even the early stage exploration companies, take Ramp Metals, for example. They've been looking for nickel. They hit gold, high grade gold, and now gold is shining, and it went up 500. It's like I doubt even, well, maybe actually if they did get a really, really good nickel hit, people actually would care. Would they care as much? I don't know. But I necessarily don't think this poll is correct. I think it's more people voting what's hurting them the most right now. Or it's like, again, the recent emotional most recent emotional pain in a sense. We know silver is very popular, but I've said this a long time. It's like for the last, maybe not actually nowadays. So in a sense, I kind of agree that silver junior sentiment has probably gotten worse. But it's like if you listen to me, I've talked a long time that I think that silver juniors actually have been priced with a speculative premium, especially compared to gold, because it wasn't that long ago the silver was down to $24 or something. Gold was still at, I don't know, $2,100 or something, and silver projects didn't look that good on paper at $24 silver. Gold projects look really good at $2,100 gold. Still, I would say most gold juniors probably were pricing in a worse spot price of the respective metal than the silver juniors. So I thought that gold juniors have been chronically cheap relative to silver juniors for quite some time. Nickel juniors, I think, is like a basket case almost. It's like ramp metals. I mean, that was down to $4 million, I think, in market cap. I mean, granted, it's a pre-discovery play, so it might not have been that outrageous, let's say. But it's like they had a pretty solid, a solid target. They had that what's his name, Mark Bennett from Sirius, the Noah Bollinger Discovery, as a technical advisor. So it's like, hey, if he's interested, it's probably a pretty good target. Fathom Nickel, for example, I mean, they have a historic resource, 2 large land positions, and I think they recently were down to, I don't know, some 6 million, 5 million market cap with pretty good results. So I don't see that happening in the silver space, for example. The same conditions but translated to silver, I don't think the silver junior would be that cheap, in my opinion. So I don't know how much I trust this poll. It's not that I think people are lying. They're voting what feels like, okay, yeah, lithium has really gotten whacked. Absolutely. So if you think of it as from an emotional shock, if a year ago or 2 years ago, it's like it was the, let's say, biggest hype train the lithium sector has ever seen, to where we are now. That's a huge fall. Whereas like nickel and gold has more, it's like death by 1,000 cuts. It's just gradually been, so it haven't had that kind of shock negative value. I just again thought it was interesting. If I had to say, I would still think that I think gold juniors are probably the cheapest relative to where the price of the metal actually is trading. Next maybe, I mean, nickel prices, for example, nickel prices are not that high. You've seen high cost mines shut down and all of that. So it's like, yes, currently the nickel price is not that good. So at face value, the most nickel businesses are not that good. So it makes sense that they're, lowly valued. In a sense, silver though, I mean, with silver $31, I think that's a pretty okay price for silver juniors or silver projects. And they're fairly cheap still. But I've seen some, kind of good run-ups in silver. So again, I don't know. I absolutely don't think there's like 3 times worse than the gold junior sentiment, at least. Lithium, for me, harder to say. Because I don't know the lithium sector that well. I just know there's like one junior I thought was cheap. They had a land package. I mean, so it was like pure potential. But it's like I think I bought it at like 8 million CAD or something. It's down to 1.5. So I mean, yes, if I look at that, that's getting absolutely killed. It's like absolute no value whatsoever put on their project. It's like they're trading at a shell value. So yes, maybe I'm wrong and lithium is actually worst. But yeah, I thought it was just interesting. So my idea, like there's so many news and stocks to cover because there's so much stuff that's cheap right now. It's like hot damn. Oh, it's so frustrating. I see stuff when like somebody pitches me something. It's like, have you looked at this? It's like, no, I haven't. But if it's a decent junior, it's probably undervalued. And it's like, it just gets frustrating because, you know, I almost don't want to look at more juniors anymore because everything that's decent to good with a shot or has a shot of having something decent to good looks cheap to me right now. And then I have, you know, I don't know, 5-10 there's like Uber buys in my eyes, and it's like 30 total of like no-brainer buys and all of that. It's like, I mean, I have no problem finding stuff to buy. So I'm especially now, it's like, or as I have been, I'm chronically short on dry powder at all times. That's why I have to, if I find something, it's like I have to value shuffle. But, okay, so this segment was more gonna be about, you know, I was gonna say, yeah, I guess portfolio allocations. Like, how do you make it? How do you make, in my opinion, a good HODL folio? Or it's like you don't need to trade much. You can actually enjoy the summer and all that. You're not riddled with anxiety, because that's the worst part. It's like seeing all the pain out there, which I mean happens a lot in this sector. First of all, because most people don't have a good strategy. Most people they don't have a really good strategy, so they don't really know in a sense why they should make money, except for, well, if silver goes to $100 per ounce, my silver junior should be up a lot and then I'll make money. So I mean, even if you think that's the case, then you know what the requirement is. You know, gold or silver goes to, let's say, $50 to $100, then all there is to do is wait, really. But you see a lot of whining. You see a lot of like, oh, how long do we have to wait? It's like, first of all, I think that's a very bad thing to do. As soon as you start whining about stuff, it's like, it's almost like you're asking for someone to save you, if you know what I mean. It's like, what can I do, let's say, if someone's like, oh, these juniors haven't gone anywhere, when are they going up? Like, first of all, nobody knows what the metals are going to do or when. Nobody. I don't know what a single junior is going to do today, tomorrow, next week, or next month, or whatever. I have a pretty good idea what I think my portfolio would have done over the next 3 years, but that's about it. Or, you know, I'm not even sure. If I had to guess, yes, I think the portfolio is going to be up a year from now relative to today. I'm more certain of that if we're talking 2 years or 3 years, because in that time, if you have a good strategy, have a good case, it's like, yes, there's going to be volatility along the way, but over 3 years, your good decision making from a due diligence perspective or portfolio allocation, that should have started to shine through. On a day-to-day basis, I might get my ass kicked by the worst investor, or a week basis, even a month basis, even a year basis. There's people that own one stock and, you know, been kicking my ass over the last 3 years, for example. I mean, typically not mining related. Maybe, you know, someone bought Tesla, all in Tesla. I saw one dude who had doubled his portfolio in 3 months. He only has Tesla. So he's been kicking my ass on paper over the last 3 months, for example. But do you think you know, long term, is that a working strategy? Is that a good strategy to own a stock like Tesla? Or was it Nvidia? No, I think it was Tesla. To me, that's, you know, that's suicide. You're asking for trouble. But as long as it works, it looks fantastic. There's a big difference between like short-term performance and the actual quality of your investing. I could go all in on whatever stock. I get a bit lucky. It goes up 30-50% over the next 6 months, or let's say 3 months. It's like, whoa. Oh man, is that a compounding pace? But that's the same problem as crypto. I know a few people who made a lot of money in crypto. But the problem for them is that, it's kind of a one-trick pony. What do you do if the top is in Bitcoin? That's the only breadwinner that's been for you. Let's say you've held Bitcoin for 8 years, 10 years. On paper, you're up a shit ton. And that's the only play you have, because for the last since inception, Bitcoin has gone up. So you have no historical evidence that it's been a bad thing to just hold Bitcoin. Your portfolio value in return is suggesting it's been a great idea, because over 10 years you looked very right. Of course, keep in mind that Bitcoin also has had some severe crashes and many 50% corrections. So as always, for a period of time, you can look super smart and super dumb. And that goes even if you have the most superb not trading, but like investing philosophy or whatever. Even Berkshire Hathaway, with the greatest investor of all time, has seen Berkshire drop 30 to 50%. Which is basically his entire portfolio. And that's from a conglomerate. It's not from a risky junior miner. It's a conglomerate. So like always, it's like if you look at this point to here, anybody who held gold would look dumb. If you looked at this part to here, looks like a genius. From here to here, dumb. From here to here, genius. Dumb, genius, and all that. But over the long term, gold has headed higher. And it's like with my portfolio. I have long periods of consolidation. I have huge drawdowns. I've had several minus 50% drawdowns in my portfolio. So I can look incredibly stupid for periods of time. Over the long run, it adds up to a higher, plus. Because my portfolio kind of goes, something like this. But in short term, yeah, you could look absolutely stupid or absolutely smart in the short term. And again, contrary to the people that are all in crypto, for example, that's the only thing they know. If the crypto sector crashed today, and it was not going to recover, not only would those people lose a lot on paper, those might be permanent losses from the top. And what can they do then? Let's say crypto never comes back, not for another 20 years. Do they have the tools, skill sets, whatever, to make money through their entire life? Not if the only play was really, okay, I'm gonna jump on the biggest bubble in history, ride it, and so far it's gone well. But let's say the bubble pops. What are you gonna do then? You don't have the tools. You've not done any real investing. You haven't had to look at whatever balance sheets or weigh risks or figure out what the value could be. No, you bet on a greater full trading vehicle that's just grown and grown and grown. So it's like that's what I think. Why I think that is in my opinion, it's not even worth it to really get into crypto in a sense. I think if you learn to invest, it's like companies. The stock market has been around for hundreds and hundreds of years. Businesses have been around for thousands of years. So if you learn to invest, unless civilization goes under, that's a skill you can make money on for the rest of your life. Whereas again, any specific bubble is something you can make a shit ton of money on for a while, but then the ride is over. So if you're a one-trick pony, you have no idea how to feed yourself when the let's say bubble pops, if that's the only thing you know. Okay, this I guess was kind of a I don't know, went a bit off topic. My starting point was going to talk about, it's like me, for example. I think I did a small trade yesterday it might have been like 0.001% of my portfolio, something like that. I mean, basically just to keep myself a bit occupied. Now, I think I talked about that on K Report. I sometimes do some micro trading, just because, okay, at least I can do something. But it's not like I'm churning over my entire portfolio. So it's like, in reality, I'm basically hodling, even though I'm doing something. So again, sometimes, because I can't, I have a hard time sitting still if I see something that's like just got whacked or whatever. I mean, sometimes I'm buying stuff that got whacked 40-50%, and I'm just buying with $300 or something. Has no impact at all to my portfolio. I just can't help myself. The idea of if there's an opportunity or not, that's what's enticing to me. And unless it's like the big changes come either when, or most of the time comes when, I simply find something better than I have. And depending on how good it is, it's gonna, I mean, if I find a new really, really good case that should be a fourth of my portfolio, for example, and not a fourth, but like my fourth largest holding, and I have 0 shares of that, and I'm fully invested, I have to, I don't know, maybe take from the other 4 big ones, for example, or take a bit from all of the small ones and some of the big ones, etc. So it's like these shrink a bit so I can buy into this new story. Stuff like that. That's typically the only times that I have some, more meaningful turnover. Or a stock is like, okay, I mean, I thought this was good, but the more I thought about it, I don't like it as much as I like some other. Or let's say one of the larger positions, for no reason, just from sentiment, etc., takes a haircut like this, and I still think it's by far the best and should be up here. I mean, that might be, I need to find, 3-4%, liquidate 3-4% of my portfolio just to get my biggest holding back to a, optimal position size. So that kind of volatility can bring out some turnover. But otherwise, I like to think of it as this. I know a lot of people, and I started out doing that as well, that I saw this pre-discovery or early stage exploration company, and it's like, whoa, what if these guys hit? What if it's a legit target? What if these guys hit? And most of the time it's been a legit target. It's just that it's been my greed that got me to like, whoa, I'm gonna, especially when I didn't have much money, I guess. It's like, oh, I'm putting 30% of my portfolio in this maiden drill play. If they hit, it could go up 10 times. That's the idea. First of all, it never goes up 10 times. Typically, it doesn't open up 1,000% plus. It almost never does. So it makes no real sense. Gladly I figured that out. It's like the risk we take a lot of the time with drilling is not worth it because the revaluation doesn't happen in a trading day. Some stores, they make a discovery hole, might be a much better buy if you pay up 100% after a discovery hole than having bought it before at 50% lower levels without a discovery hole. I mean, it might be a sell at 50% lower price the day before the announcement, and the day after the announcement when price is up 100%, that might be a no-brainer buy all of a sudden. Which, again, if people use strict rules like never chase, or it's like if you owned it pre-discovery hole, it goes up and you have that rule of, never, sell half after a double. If that doesn't make sense, maybe you should have tripled your position or quadrupled your position after it has run up 100%. But you sell half instead. That's a monumental mistake, isn't it? Or if it's a clear buy after being up 150% the day after an announcement, but you, quote, don't want to chase, so you don't buy it. That's obviously a colossal mistake as well. So I think there's a lot of stuff that, like crutches or saying, that's like, They really don't make any sense to me. That's why I don't use any sort of rules. I don't have a position size rule. I don't have anything. I only do what makes sense. Try to, at least. Because, I mean, sure, sometimes maybe that, okay, you have a stock, it goes up 100%. Oh, I sell half because it's doubled. You use that rule. Then it goes down or crashes, and you're like, oh, thank God I had that rule. That particular time, just because you had a strict rule, yes, you made more on that story, and you saved money, let's say. Or at least saved money. So then you're like, whoa, I mean, this is a good rule because it kept me out of trouble. Sure. But then one of those comes around where it's, again, let's say a discovery hole happens or something happens, makes it go up 100%. But the value actually went up, even risk-adjusted value went up 400%. And you sell that because you have a memory of like when that saved your bacon. Then it goes on to go up 1,000% over the next 2 years. That might cost you a shit ton. That might cost you a lot more than what you saved on the ones that failed. That's my problem with strict rules. Strict rules make a lot of sense if you know, or I should say, if you don't know really what you're doing. I mean, strict rules are good if it keeps you from making even bigger mistakes. So that I guess you need to figure out yourself. So I guess I'm saying that I'm not against using strict rules. Hopefully, I mean, when you really understand stuff, I don't think you should need strict rules. Because there are times it saves you money, or you get a profit. Yeah, mostly I guess save money. But there are times I think it could cost a shit ton as well. I mean, let's say let's say you have 5 stocks, 4 or all 5 double. You cut your position in half on all 4 or on all 5. 4 actually goes down again, so it's like you look smart, you save money. The 5th one, which is one is like you don't know it at the time, but let's say all had really good potential after they doubled. But 4 don't pan out. So you saved money by selling half after you took your money back. Okay, you're free rolling. But the 5th one actually delivered. It's like, yes, after a discovery hole where it's like this could be really big, it actually ends up being really big. So it's, let's say, 20 to 30 bags over 3 years, like Great Bear. If you sold that, sold half, for example, the fact that you sold that is going to cost you a lot more than you saved on the 4 other ones. That's my point. But at the same token then, if you use that approach, it's like, okay, I'm going to actually, let the winners run, or I have the fortitude or whatever to stick it out. In that case, or you would need that obviously for it to pay for the other ones. Like it's got to make sense. There's like, you have to have some big winners, and you have to make sure in that case that you are able to have some big winners. But that's actually another topic as well, I guess. But okay, so let's again try to get back at the topic I actually had in mind. Portfolio allocation. So in my opinion, the risk should be the main determinant of position size. That simply goes back to compounding. You can't compound a loss. A permanent loss amounts over time to maybe a huge amount, depending on how good you are at investing, obviously. I mean, sometimes if you're really, really crap at investing that you're going to go to zero anyway, you might as well go to zero today and then do something else. Instead of getting, death by 1,000 cuts. Wasting time, money and energy on investing, and it's like 10 years later you're down to zero. You might as well have gone to zero today, found a job or again something else to do, But if you believe, or if you are determined to learn and yada yada, that you have, you know, positive expected returns for your portfolio in the long run, permanent loss is something we don't really want. So like the way I look at it, I love exploration. I think it's so cool, it's so fun, it can be exhilarating and all that. And I think there's a lot of stuff out there that has a shot of having something. Most of them will not end up having a tier 2 or tier 1 discovery, you know, early, from a grassroots or early stage position. Most pure explorers will not work out, because there are not that many tier 2, tier 1 projects found in a year or even a decade. And if you have 40 juniors, the odds of them having 40 tier 2 or tier 1 deposits on their hand, or, you know, coming discoveries, that's a stretch, I would say. So like I have some juniors that I'm pretty big in. You know, a few percent of my portfolio to actually over 10%. I'm not going to say more than that, because sometimes, yeah, I can have really crazy position sizes. Most of the time, they are the ones where I think there's a low chance of ultimately losing money on from these prices. If I think value of these is up here on average, to my best guesstimate, it's like, let's say, proven success and all that. And I think the team can execute whatever, and I think that they have, you know, much more growth potential. I'm not worried about them. Because if price is down here for these companies, I think value is up here. Then you know, that's just, let's say, returns waiting to happen. Even though obviously that's not 100% the case, because stuff can happen. Political stuff. I mean, if you're in producers, for example, you can see tailing dam bust and all of that. So it's not like you can take it to the bank, and that's why you're not all in on any one. But these are the ones I'm not really worried about, because I can see something happen that will make them go being valued less than what the current price of these companies are. So I'm not having sleepless nights, because I'm so, you know, sure that, hey, value is up here, just based on what's already proven. It's not like I'm taking a bunch of exploration risks. No, someone else took exploration risk, for example. I think the value is up here. So in that case, again, not too much to worry about. I think they have margin of safety. So I don't worry too much about these stories. But the ones that are more like they don't have a deposit, they're delineating a deposit, whatever. It's like the higher the risk, this is the risk curve, the smaller my position sizes are. I mean, I have positions, a lot of like exploration type cases, you know, early stage. They might be, I don't know, 0.2% of my portfolio. 0.3, 0.4, 0.5, you know, a percent, maybe some 2%. Condor, for example, was several percent. And that led to a big paper loss. But that was unusual. That's like, I thought that was such a good target and all that. Most of the time, at least nowadays, my pure exploration positions, they are relatively small. And in that case, that makes it also easy to HODL, because let's say you have a 1% position of a high risk, high reward place. Like, you know what the target is, it's an obvious target, they're priced like they have no chance of having anything. One of my favorites, for example, is like Inflection Resources, priced at 16-17 million CAD. You know, it's pricing in no sort of chance of finding anything worth of value. Okay, right. Let's say you have a 1% position in that. What happens after this? entire drill campaign with Anglo Gold is a bust. They don't find anything, not even any more sniffs, even though they already have sniffs. But let's say nothing at all comes out of that endeavor. Okay, it drops 50%. So even if you had a 1% position, your portfolio goes down 0.5%. And let's say, I mean, they have other projects as well, so it's not like everything is lost. But let's just stick to, the copper exploration. Okay, it drops 50%. Your portfolio took a 50% hit. It's like, who cares? 0.5% hit. Who cares? My portfolio swings more than that on any given day. I see juniors, I see my portfolio go up or down 2-3% per day. It's not like it doesn't matter at all, because if it's a permanent loss, it's a permanent loss. It's just that I don't need to stay awake worrying about a bunch of 1% positions or 0.5% positions or 0.4. The trick is obviously if you buy them cheap enough, like in the case that inflection actually does end up making another North Parkes discovery. In 3 years, that stock could be 30 times higher. So if you have a 1% position in that case starting off, and you would actually, let's say, you were able to ride it, not sell half on a double and all of that, theoretically, that 1% position added 30% to your entire portfolio. So the way I view it, in a sense, with a case like that, is like, okay, let's say it's high risk. Let's say there's 70% chance of failure. 70% of the time I will lose half a percentage of my portfolio in a stock like that. 30% of the time, and that would be extremely good risk reward if that's actually the case, but nobody knows what the actual chance of success is. 30% of the time it ends up making a 30 bagger over the next 3 years, let's say. So okay, why should I really be worrying in that case? First of all, they're doing the work, they're drilling. All I can do is wait. It doesn't change the fact if I look at the position. The metal prices don't really have much effect. Either they're going to discover something or not. Right? So it's like the metals really don't play any part of it. I can't do anything actively to help them make a discovery or anything like that. So over the next, let's say, after the next 20 news releases, let's say, they're either going to have found something or not. If they don't find anything, I might take a 0.5% hit to my portfolio. If they find something, that might be the start of a next 50 news releases that brings it up, hundreds of percent. So why should I lie awake worrying about a bunch of positions that's like, let's say I have 20 high risk, high reward exploration stories and 1% each. Okay, that's 20 positions, 1% each. No single one of those cases. I can't wake up to a news release and it's like, they drilled dusters. Now my investing career is over. No, my portfolio might take a 0.5% hit that day. Who cares? Go back to sleep. If they do end up finding something, it's obviously also easier to ride a big revaluation move if you start off with 1%. If you put 30% in a high risk, high reward story because you want to, quote, get rich quickly. Let's say the case, the mathematical case really only makes sense if you allow it to run as well, again, to offset the many ones that fail. If you start off with a 30% position, after it goes up 100%, it's at 60. You can be sleeping well. You probably shouldn't be sleeping well if it's already at 30. After just one double, you're gonna be sweating bullets. How on earth are you gonna I mean, that's crazy to begin with. It doesn't really make sense, because if you have a high risk, high reward positions, if you have 30% in one, there's not enough portfolio left to diversify away that risk. Theoretically, then it would be like, okay, you have a 30% position, then two other high risk, high reward 30% positions. and let's say you have 20% chance of success or 10. It's not out of this world that all 3 would fail. And you take a 50% permanent loss in all 3. Then you cut your portfolio in half. That, from a compounding perspective, that's gonna... you don't even want to think how costly that is in the long run. Because I've done it myself, right? I've taken huge losses. I was all in Novo, for example, when it went down 30%. Even before that, I think, I was 30% in a high risk, high reward maiden drill play. Lost 50% there in one day, etc., etc. But you don't need to start off with perfect strategy. Nobody has a perfect strategy. Or perfect portfolio allocation, whatever. The trick is to learn. So it's like, I think I'm getting better each and every year because I constantly think about this stuff. So, okay. To summarize, like, why can I be pretty chill and enjoy the summer? Well, simply because I think I have a pretty good... I actually... Some positions are way bigger than I would suggest anyone else has, but hey, some are actually private, so I can't even do anything about it, and that's also, it's like, oh, it's out of my hands. That's actually pretty nice. That's why I kind of like holding periods, actually, in private placements, where it's like, if I can't do anything, there's nothing to worry about, really, because there's no action to take if it's locked up. But anyway, so it's like, yes, I think risk should be the main determinant of position size. How likely am I to, if I give this story 3 years or 5 years, whatever, how likely is it that I'm going to be losing money on it from this level? That they will be destroying value so much that if I think the value is up here now, first of all, I can be wrong on the value, obviously. That's why you don't stick to any, you don't go all in any particular company. And then they can also destroy value. But it's like, if I think there's an 80-90% chance that a story is worth a lot more, and then by default, one assumes it's just a matter of time before you're in a green, then I can have pretty big positions. Let's say I have an 8% position in one of those, contrary to a high risk high reward play where there's an 80% chance of of the company not finding anything and a 20% chance it becomes a 20 bagger. If I have a 0.5 position, I'm obviously 16 times heavier in the one with much lower risk, and that I think is absolutely fine. Some high risk high reward plays I have 0.2% position in. That's one of the low risk is I'm 40 times overweighted. So I'm 40 times more bullish in a sense on the low risk. So I think there's like some cases I think are just head and shoulders above others, and they can all be buys. It mostly comes down to the risk. So let's say my low risk portion of the portfolio makes up 60-70% of the portfolio. So I would be kind of surprised if I, at the end of the day or the long term, lost money on them. And especially like heart attack surprised if I would lose money on all of them. And obviously the beauty is that I think all of them are cheap and hopefully they also have growth potential. That means that not only do I expect to make money on these over the long term, don't know when, but over the long term, I also think that if I expect to make this amount of money on them, on average, they also have growth profiles that if they deliver on that, it's not this I expect to get, it's even more with time, the more they can prove up that what I hope is there is there. So this is like what you kind of take to the bank in terms of returns. And then you have the free optionality of exploration potential. It's like, why I like First Nordic so much, for example. I think it's so cheap based on what's already proven. Real risk that somebody else took and got favorable returns for or results on. but also has, a huge land package and a bunch of targets. So that's free optionality to me. So if I have a bunch of those, it's like, oh, this is a solid deposit. This is obviously worth something. Can something happen? Absolutely. There, you have to go through permitting if you're actually going to build it, whatever. But at face value right now, it's like I'm not even taking risk. I'm buying something that's worth much more than what it is priced at. So at face value, I'm not even taking risk. This is, a return waiting to happen in stores like that. That's my view on them. But since stuff can happen, you don't go all in on any single one. But if you bunch a few of those together, and you think they're so low risk with so good risk reward because you have free optionality, maybe you have a few that makes up a large part of your portfolio. And this is much more riskier than most people would. I mean, it's like if you listen to Rick Rule, for example, I mean, he kind of advocates that maybe 10% of your portfolio should be in mining stocks and 10% of that 10% is going to be in juniors. I'm 100% in juniors. So keep in mind that my approach from the get-go is probably much riskier than most, but that's the only thing I can talk about because that's what makes sense to me. Because I think juniors are the most undervalued ones, and I can stomach the volatility, and I can buy low, etc., etc. So I know I can do this because I've done it, and I expect to be able to keep doing it. But anyway, so this portion, let's say it's 50% of your portfolio, whatever. Made up of, let's say add a few more names here. Let's say you have 10 juniors that makes up 50% of your portfolio, so like 5% each. Those are the ones you expect to someday have a return on. You're not worrying about them. First of all, they're quote only 5%, and you think base case is that they go up 200%. They're just returns waiting to happen. So you don't lose sleep on that because like you already know that what they've already proven is worth a lot more than what you're paying for. So the risk is to the upside. The risk is not to the downside. I mean, at face value. Then you have maybe 50%, let's say, of the rest of your portfolio, a bunch of high risk, high reward, where it's like the margin of safety, there is none. The risk is that they go to, theoretically they go to zero. Most of them will, a lot of juniors won't actually go to zero because, they'll find something else or they have another project or whatever. There's only a few cases I've seen where they actually go bankrupt. But anyway, so yes. But theoretically, minus 100%, let's say base case minus 60% or 70%. That's risk. And that might be the base case, that they're not going to find something. So the base case, let's say, for each of these is that they're going to go down 60-70% in time. But the anomaly, let's say, is if you make money on them, because they might be starting off at so low valuations that the few that actually do end up finding something, proving something up, having made a discovery, etc., they could go up 5 times, 10 times, 20 times, 30 times, depending on how long you're able to hold it and how good the case plays out. But you're not worrying about any single individual one here. Because you might have a bunch of 1%ers, a bunch of 0.6%ers, a bunch of 0.5%ers. And again, the beauty of that is if one of those make a, early stage exploration play, they make a discovery hole or they have a discovery hole and you're like, okay, this could become something big. Okay, it could, okay? And you have a 1% position. And again, to make your high risk, high reward strategy play out where you have like 20 to 30 names, all high risk, where you need a few of them to pay for a lot of the other ones, so it means you have to ride them. It's much easier to ride them if you start off with a 1% position or less, because even if it doubles, it's only at 2% of your portfolio. You're not going to be sweating bullets. Not yet, at least. So that makes it a lot easier to capture the reward side of things, which is required for the high risk, high reward portfolio approach to even make sense. Because if you take high risk, high reward positions and you sell all of them on a double, there is no way for anyone to pay for a lot of the other ones. So by default, you've already failed because you have a faulty high risk, high reward strategy, it doesn't make any sense. Because in reality, that's a high risk, low reward portfolio you have. I hope that makes sense. So, okay, if you know that, okay, in order to have a high risk, high reward portfolio to be sensible, let's say, okay, that means I gotta capture because it's the reward side that's obviously, flexible, because every single junior can just go down 100%, but it's the upside that separates them. That's how you pay for the high risk, high reward. It's not high risk, low reward. That doesn't make any sense. But if you have like 20, 30 position, and let's say, whatever, some are 0.5, some are 1%, some are 0.3, some are whatever. I mean, one thing I would say is like, if you have too many, that's going to be hard to follow, I guess. It's like, I mean, if you had 50% of my portfolio is in high risk, high reward, and I don't want anyone to be more than 1% positions, then you're up at 50 positions just for the high risk, high reward portion of portfolio. That's going to be hard to follow, and I doubt there's 50 really good high risk, high reward plays out there anyway. So it's totally fine again to have like 80% of your portfolio being relatively low risk, 20% of your portfolio being high risk, and you have 20 cases, because 20 cases is still kind of enough to have the probabilities, etc., for the math to work out, because you need, let's say 2 in 20, that becomes 10 baggers, whatever, and that might be okay, yada yada yada. Or one becomes a 10 bagger, one becomes a 30 bagger, etc. All of a sudden that portion of the portfolio is paid for itself. And again, the beauty is that if you have a 1% position in a high risk, high reward play, are you gonna care that much? I mean, I'm in a bunch of explorations stuff. How often do you see me threat or worry about all the juniors I have? I mean, nowadays I don't even post that much in the forums in any particular channel, because you got to let the cases play out first of all. So it's a bad sign if you have high risk, high reward cases where it's like you're watching it every single day, kind of. I mean, that tells you have too much in it. I mean, there's a bunch of stuff. It's like I got a bunch of copper explorers and, some gold explorers, some silver explorers as well. I just think they're cheap. And it's like, whatever. Take Western Alaska. They're drilling for silver. Do I think they could have a really good high-grade silver deposit there and prove it up? Yeah. Is that going to happen tomorrow? Nope. I just look, okay, what are they priced at? Let's say I give these guys 2-3 years. Let's say they have some success. Let's say they find extension of last hurrah. It's like, lo and behold, 2 years later, it's like, yeah, we think we got 150 million ounces of high grade here. It's like, oh, well, that's a mine. That's a high grade mine probably. It's like, oh, what's that worth? Oh, I don't know what silver is at that point either, but let's say, oh, that's worth several hundred million. Okay, what did I pay for it? Let's say 40 million. I mean, obviously I would expect to make money from this price. But it's not like I can buy it at whatever, 40 million. It's like, oh, a week from now it's going to look cheap. It's like, they haven't had time to do anything. So there's not much to do except wait. So that I guess encapsulates it all. It's like, how can you HODL? First of all, long-term cases make sense from the get-go, because that's what nobody else is thinking about. So my beefier positions, typically they are ones that I don't think I have much to worry about. Take Magna Mining, for example. The best team you can probably ask for, huge skin in the game. I don't second guess a single decision they make. They know better than probably anyone else in the entire mining space what to do, what's the best thing to do. They have money at risk. They're going to be obsessing about Magna every single day, 7 days of the week. And they make better decisions based on the situation than anyone else can do. So what's there to second guess? They want to build $1 billion+ company. We know what it's trading at. If they do it, I'm going to make a lot of money. If they don't, I'm going to lose money. But at least it's like, okay, you have the best ones to actually make it happen as well. The only thing you can do is allow them time. Time to build, time to prove up, time to de-risk, time to make discoveries. Time to do what they do best. So if I give them 2 years, I think they will have created more value than if I give them 1 week. Because a good management team, time held is typically correlates with higher returns. So I don't worry about that stuff much. I don't worry about positions like that, because I know it's like I have full faith in the management team and all that. So if I have a bunch of positions like that where it's like, okay, I expect to make more money the longer I hold them. So what's there to do than wait in that case? Nothing really. And I don't fear like, what they have is, what the price is right now, looking at what they have. It's like, what are the odds that what they have already is going to be, in the end, worth less than the current price? If I see that's like probably very, very low chance, like 80, 90% chance it's not going to be worth less than what I'm paying for it. So I see it's like, 90% chance I'm going to make money. And then there's just degrees how much money I'm going to make at the end of the day. Well, that's not something to worry about really. And again, the higher risk ones, they're typically at a position size where it's like, I don't really care. Where it's like you see, let's say I get trolled sometimes and it's like, this stock is down from whatever. It's like, how can he make any money? It's like, what, do you think I'm all in on every single high risk, high reward play, if you know what I mean? I mean, that more tells them how they do things. I would say I am, especially now from the highs, it's like I have more losers than I have winners. The whole idea is that the ones that do make it should return even more. And again, it's like, you see some people bragging about whatever. They have some microscopic position in some high risk, high reward case. It goes up and they brag. It's like one of my bigger positions is like if you have a 1% position, it goes up 100%. And you're like, woohoo! That's 1% to your portfolio. Whereas a 5% position goes up 20%. That's also 1%. It doesn't look as flashy because it's only 20%. But that's as much as a 1% position going up 100%. Same effect to the portfolio. I mean, even one of your larger ones that you're pretty sure is like, okay, they go up 50%. And you're not there celebrating whatever, and you see someone has a stock that goes up 200-300%. You might have made more money than him anyway. And if there are people who are like, I bet almost everything on this high risk, high reward thing and it works out, and he's celebrating like crazy and you feel dumb for not being a part of it, whatever. It's the kind of same with crypto. I mean, fast forward his approach. He needs to get lucky every single time basically if he takes huge amount of risks with majority of his portfolio. I mean, let's say, okay. Let's say you go all in a high risk, high reward play. It works out. They hit. You're not going to be sitting there with your entire position, I don't think, after it's up 500. Maybe you start to take profits at 100% up. Then take profits more and more. So let's say you do end up making 150-200% after you've gone all in because you can't stand the stress after you can't ride the whole thing up 5x. Even if it's gonna end up going up 10x or 20x or 30x, then you do the same thing because now you taught yourself, well, hey, this worked. You're going to another high risk, high reward play with your entire position because you just learned that, this works, I can do this, I'm magical. Boom, minus 50-60%, they miss. Okay, crap. Now you're feeling really, really bad. What do you do then? You probably go on tilt. So you go into another high risk, high reward play because now you need to make that money back faster. That's how you think. And you did it 2 cases ago. Go into another one, boom. balance of probabilities, which dictates that most maiden real campaigns, for example, will not make a significant discovery hold. Okay, minus 50-60% again. Next one might fail as well. You know what I'm saying? It's like people can make a lot of money for a period of time on very bad risk management or bad strategies. It's a long-term game that matters. That's the long-term portfolio returns is the only thing that matters. And this makes sense to me, and it makes also sense that, okay, if I have a lot of positions that are larger that I don't have much to worry about, then I won't worry much. Then I have a lot of high risk ones, but they're small enough that I can capture the reward side of the high risk high reward function, plus no single position is big enough that I'm gonna lose sleep over it anyway. So there's nothing to worry about, so you can just, again, there's not much to do. Then let the cases play out. Maybe one case needs a year, high risk high reward case needs a year, or at least a drill season to show something. So okay, in 6 months I'll either be down 50-60% or up. Okay, nothing to do but wait for 5-6 months. The same with most of these, perhaps. Okay, nothing to do for 5-6 months, and these are like, you're just, again, waiting for the margin of safety gap to close, the price to value gap to close. That's all you can do is wait, because you don't know when that's going to close. So the end result is a portfolio where it's like, hey, this is quite easy to HODL because I don't have much to worry about. And all of the cases are built on, like, what could happen over the next 6 to 18 months. So on a continuous basis, I don't have much to do really, except do more due diligence, maybe finding some stuff that's better than some of these. Or sometimes you have volatility that's like, okay, this one goes down, but I still like it and like it even more at this price. So you sell, you sell, you sell, you sell, and then you draw that position size up here, for example. Yes, volatility does affect stuff. Price, that's the only thing we can control. What price can we pay? The price we pay, what is Mr. Market offering us? Again, I think this is absolutely the hands down. I mean, this is like, 8-9 years of doing this. This is how it's kind of, distilled down to. This makes, I think this approach makes sense from the risk in the sector. It makes sense from, an investing theory. It makes sense from, okay, how do I put myself in a position where I can make money on my vacation, if you know what I mean. If you're a day trader, as long as you're not trading, you're not making any money. If I have this approach, I expect that, well, if all the cases are built on this next 6 to 24 months or something, theoretically I should be able to go on a vacation for at least 6 months, because that's how long that, the minimum time needed for these cases to play out. That I think they're cheap based on what could happen over the next 6 to 18 months. So that frees up time to, again, do real work, which is due diligence, to, spend time with friends, yada, yada, yada. Whereas, like, you see some traders, like, they burn themselves out, let's say. It's like they have a shitty, whatever, they go on tilt. And it's like, a trader is like, the only time you work as especially a short-term trader, is if you're at the computer. Some of my best portfolio weeks, let's say, have been when I'm on vacation. For some reason. So I'm making money when I'm not doing anything. I might be making more money when I'm not doing anything, because then at least I can mess something up by over trading. So so it's like, again, the idea is to get better and better and better. Compare that to if you're a one-trick pony, you're only into, let's say, Bitcoin, for example, or whatever crypto, or whatever scheme I was going to say. If you made all your money from just holding, that's the only thing you get taught. And it's like I don't think Bitcoin teaches too much about investing except for psychology. So that's one thing at least, that if you've been able to HODL Bitcoin, you suffer through immense volatility, but you still don't have a have real good grasp of, like, price versus value, if you know what I mean. It's more like a big greater fool. So the psychology aspect of it, that you probably are very good at. So you'll have a much easier time to transition to investing. But it's not like, oh, I'm selling my Bitcoin or whatever, and then I'm going to go and invest and immediately imagine I have a, working investing strategy. That's like I'm going to make money for the rest of my life. No, you probably don't have the tools yet to do that. So then that's going to be a process of maybe years, if ever, that you have to figure out how you make actually money in investing. So I think, again, it's like put in the time to learn investing, because, then you could take your lessons, learn investing in miners, and go to whatever, biotech, anything really. Especially volatile sectors, I think, if you, again, get accustomed with that. So that's what the Bitcoin guys at least probably got. There's like they can suffer through immense volatility. The problem is, of course, that if it's tied to the idea that, well, I don't know what the value is, but everybody says it's going to go up to $100,000 or $1 million per coin. That's like, yes, that's going to keep you in the game, the conviction, but it's like it's not really based on anything. In investing, it's like I might have high conviction about a company, but that's because, like, you spent a lot of time to try to figure out what you think the value of it is. Not just that, oh, I have a lot of conviction because some guy said it's going to go up 10x for no other reason than I want it to, if you know what I mean. So it's like that's more conviction based on, flimsy fundamentals, whereas like if you have done a lot of work on a specific company and you think that, hey, this is worth a lot more. I could get a 5 to 10x in this with time because I think it's worth that much. Then that conviction comes from like serious due diligence, not just, again, listening to Cathie Wood say, Bitcoin is going to 1 million. That's our base case. Like, okay, how do you imagine that? It's like, look at these, whatever. There's 1,000 ways for people to try and value Bitcoin or explain why it's going to go to whatever point. But there's not 1,000 ways to look at 2 million ounces of gold, if you know what I mean. So yeah. Oh, this turned out to a long rant. Anyway. That's about it, I think. I hope you got something out of this. So it's like, again, I think where I should end with, from a quality of life perspective, I want to be able to make money at all times, even if I'm not looking. What requires the least amount of trading, least amount of anxiety, makes sense over the long term, and is, I expect to make money on it, if that makes sense. I don't envy the traders because, I just don't envy traders really. Because you have to be constantly at the computer, whatever. It's like, it broke down. All of a sudden I got to do something. Whereas a value investor is like, who cares where it's going in the short term? My case is 6 to 18 months out. It's like, matters not. I can go on vacation, no problem. I just have to look at the news that comes out. And typically a company might put out 2 news releases per month. Maybe one is material. Sometimes it's 4 months before a material news release is out. In the meantime, I'm just going to be on the lookout for, let's say, huge volatility. Oh, this stock, which nothing has happened at all with, like, no fundamental reason for it to go down. It's down 30%. Okay, I'll take some of that. So it's like you're more, I don't know. I guess, reactive. It's like you take what the market gives you, and then most of it is just waiting. So again, it's like most of the HODL folios, there's almost no trading in them. My portfolio, a lot of stuff is locked up anyway, but I haven't made big changes. Most days, over the last 6 months, it's like most days I don't do anything. I don't trade anything. If I do, it's typically like to keep myself sane, in the sense something goes down, I take a bit more of that, but that might be a 0.1% position or 0.2, but it's like I feel good jumping on opportunities. It feels like I've done something. I like the idea of buying opportunities, but that doesn't happen every day. It's like you gotta wait for some volatility and all that. If I mention any companies, assume I'm biased, or consider me biased, assume I own them, assume, well, some are sponsors as well. So again, consider me biased. This is not investing advice. Don't risk money you cannot afford to lose. Again, it's like this approach being 100% in juniors, that's still crazy stuff to most people. So I'm not saying what you should do, I'm explaining what makes sense to me. Maybe you shouldn't be in juniors at all, I don't know. But I can only talk about stuff that makes sense to me and has worked for me, so that's the thing. Not investing advice, don't invest money you cannot afford to lose. If you like these videos, hit a thumbs up or something. And I would say also that, if there's some, topics, for example, leave a comment on the video, because it's more fun for me if I can talk about stuff that people actually want to hear and get some value out of. And also, it's like I typically don't comment on companies I don't know that well. I know some, it's like they have to have an opinion on everything. I have no problem saying if I don't know anything. And most of the juniors that I don't own, I don't know much about, might have a comment or whatever. But yeah, I'm really only comfortable mostly talking about investing strategy and companies I actually do know, at least. Thanks for listening. Bye.